Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, this is John Brackett. I'm here with another great guest. I have here Kay Kay Singh joining us today, and Kay has some great ideas, concepts, and information to share. Of course, this is the podcast, We Build Great Apartment Communities. I am your host, John Brackett. Welcome to the show. Kay Kay, welcome to the show.
Thank you very much, John, for having me on your show today.
You're very welcome. I am going to introduce you, Kay Kay, so that our audience, that they have a pretty good pic of who you are and what your background is, so they can start participating in the conversation with us. I'm going to just give our audience a summary of who you are and your achievements. So I'm going to start off by talking about your Microsoft certification. So Kay Kay, you're a MCSE that, over time you've turned into a successful multifamily real estate entrepreneur. You've owned gas stations, convenience stores, laundromats. You've owned over 40 single family residential properties in different states. And you've also been an investor in apartment buildings, close to about 2,800 apartment buildings as limited partner, as also general partner. And you've syndicated these deals in states throughout the United States. So one of the things that I find fascinating, and I'm going to have you talk about this a little bit, you also have investment properties, own investment properties in India as well, right? So you have some very unique experiences, not only doing business in the United States and in different states in the United States, but you also have some international business experience. So, Kay, welcome to the show. Can you share with our audience how long you've been doing this and why the different states? How did that come about?
Thank you very much, John, for introducing me. Such a nice introduction here.
Sure.
Almost you went through everything, but I can go on and on. So I came to United States along with my family, my wife and my 3 kids in 2000. And I had a job since I was Microsoft certified system engineer. So I had a IT job, which I lost immediately after 9/11. And that landed me in the gas station business.
Interesting.
So I had friends, they had 2 gas stations and they gave me an opportunity. They gave me a partnership. I had to work as a cashier for about 4 months. And after that, they gave me a partnership in one of their gas stations that they recently acquired. So from there, I got into the gas station business, but that was all in Indianapolis. That's where I came to.
Sure.
After about 6 months, the lease expired on that gas station. We were doing good on that gas station, and the lease expired. And then I liked the gas station business. There was good cash flow. And of course, it's a hard work, a lot of hard work. Yes. So after the lease expired, we moved to Fort Wayne, Indiana, and bought a gas station in a low income neighborhood, a small gas station with partnership, my nephew and my cousin. We bought a gas station. And from there, we started on. And for the first 5 years, I just owned that one, because my cousin decided to go back to India. He didn't like the gas station business, so he went back to India and I had to buy him out. And after that, in 2005, we bought another one. And my nephew also moved from Indianapolis to Fort Wayne. And after 2000, we bought a gas station every year until 2012.
Interesting. So, the gas station business is an interesting business, right? When I was in commercial banking, I used to finance gas stations, and I financed quite a few over the years, when I was in banking. So what attracted you to the gas station business? I mean, usually there are a couple of components, a couple of things that entrepreneurs are very attracted to in specific industries. What was it about gas station investing
There is one in gas station: cash flow. There was good cash flow, and we were doing everything ourselves. Even we were the cashiers. So
Sure.
to start with, we had no employees. So cash flow was good. That made my interest in this business. I have been always a hard worker throughout my life. So I was spending like 12 hours a day, 80 hours a week on the gas station and making money, of course. So
Sure,
that
sure.
attracted me to buy more gas stations. And then I kept buying more gas stations, and some of my employees, they became my partners, and they are still my partners after 20 years.
Wow. So now what made you then transition from gas stations into your next investment vehicle? And what was that? Did you go from gas stations directly into apartment buildings, or was there a progression?
No, in 2012, I decided to diversify myself. I had 8 gas stations at that time. So I decided to diversify myself into laundromat business. So I did the research for the whole year and built a laundromat by my first gas station that I had bought back in 2001. So I built it from ground up. It's a very high-tech laundromat. So it's all card system and operated over the phone and computer. You can operate that laundromat from India as well.
Oh, wow.
So I liked that, and I was thinking of building 4 in Fort Wayne. Fort Wayne is a pretty good size city, about 275,000 people here. In the meantime, several of my friends built more. They copied me and built some laundromats. So I decided not to do that. And in 2014, actually 15, I was offered a portfolio of 33 single family houses by one of our community person. He was an elderly, 82 years old, retired landlord. He wanted to retire, and he's from our community too. And he offered me this portfolio at our church.
Interesting. Interesting.
So I asked him to give me 24 hours to make up my mind, because I had never done this stuff. So after 24 hours, I said, yes, we'll buy those. And the reason he wanted to sell it to me is because he had sold those houses twice, but they couldn't get financing.
Ah,
So he knew that I could get financing. So he decided to sell it to me, and we decided to buy. So we bought his 33 houses in one shot. And then soon after that, we bought 7 from his son too.
wow, interesting. So, KK, I know it can be difficult when you're financing 40 plus single family residential properties. The debt financing can be a little bit challenging. How were you able to get that done? And is the lender still around? I know some of the portfolio lenders are still around. They're tightening up now in this market, but how were you able to get that done, and what was the structure on that?
I had some loans on our gas stations as well. So throughout the process, we were buying gas stations. So some of them we bought with the property, some of them we leased. So lease means you have to pay cash, and when you're buying property. So when we bought a gas station in 2005, we had a loan from a local bank. We had 3 loans actually. We had a loan on the car wash, we had a loan on the business, we had a loan on the real estate.
Interesting.
So we paid them all off, but some of them were paid off, some of them were very close, and we never missed installment. So the bank was very happy with us. And I went to that bank, and I went to a couple of banks. I went to my own bank. My own bank didn't want to finance these single family house rentals.
Interesting.
But I had these 2 banks, they approved me for the loan, and I decided to go with one of them. And we have had, and the same officer that dealt with me like 15 years ago, and he approved our loan and everything. And after even we sold those houses, so he approved another loan for us for an apartment building.
So that's how the transition happened. So what made you go from, which is a natural progression, but what made you make the transition from single family residential properties to apartment buildings?
So when I bought these single family houses, I started managing myself, because the landlord that I just talked about, we call him Uncle. So Uncle decided to, because I didn't even know what a cap rate is at that time, because gas stations is totally different animal. They're bought with the inside sales and all that. I knew all that, but I didn't know how to buy the single family houses or the multifamily houses at that time.
Right.
So we just trusted him what he said, and he gave us a pretty good deal. And in 5 years, we 10x'd our money. And he was supposed to help me for a year managing those houses so that I could learn the business.
Right.
And after 10 days, I did let him go because he was old school. He wanted me to do everything with a pen and pencil. And
Oh.
since I was an IT professional, so I said, no, uncle, I can't do that. I have other businesses. I have to look after them. At that time, I was managing a laundromat and a gas station as well. So I said, I have to figure out some easier way to manage these properties. So I did let him go. I started learning on bigger pockets online. I did a lot of research. I'm good at research. So I did a lot of research and moved all my single family houses to a software, the property management software. And that made my life a lot easier.
And so what was the software program that you first transitioned into? What was that software program?
I did research several of them, but I liked Buildium.com.
So it was Buildium, yeah.
It was Buildium.com, and I still have a subscription on that, though we have sold our houses. I have to have it until March of next year to file taxes. I like that program. I mastered it. They have an online training and everything. So I did all by myself, and I managed. And soon after I got into single family, and we bought them in June, and we ended up paying a lot more tax next year, because I thought when you get into real estate, you don't have to pay much taxes,
Right.
because we had a lot of cash flow from our laundromats and gas stations. So I was paying a lot of tax. So I thought that would help me, but instead I ended up paying more tax.
Interesting.
So I said, what the heck? I should have saved money on the tax, but I ended up paying more. So I need to figure it out. What's the reason? So after doing my research and everything, I came through the syndication process in the very first year after owning those single family. After 6 months, I started researching into it. So I learned about the syndication process. I learned about the cost segregation strategy and all that. And I started learning more and more. I started attending boot camps, e-boot camps, and all kind of networking events.
Sure.
And I immediately started investing passively in the apartments so that I could learn and make a relationship with those good operators.
Well, you know what? I really like that strategy. So I'm gonna comment on a couple things, but first let me walk our audience through this, okay? Because we have a unique audience in that we have some folks that are just looking to get into this business. You know, we have quite a few that are seasoned operators that tune into the show, and then we have the balance that are limited partners. I really like what you said in that you really started investing time and energy into learning this business through self-study. But then, once you've got your hands around this, right, you took another step, which was identifying other professionals in the space that you then started to partner with passively through limited partnerships. What was the biggest takeaway from that, KK, when you started making those investments as a limited partner? What was the biggest lesson learned through that experience, because it evidently allowed you to propel forward and then grow your portfolio from there?
Definitely, I learned a lesson that once you have your own money at the stake, that's when you start learning. Because if you keep learning, you might, if you don't take action. And I have a lot of investors that I talk to each and every day. They are fearful, and the reason why they are fearful because they lack knowledge. Or they have too much knowledge, they don't take action.
Not enough action, right?
Enough actions. They're just learning and networking and wasting their time, because it's not going to make them any money unless they take action.
Right.
So I did the same thing with the passive investment, and that's my nature. I have to put myself on the stack to learn something.
Right.
So I had a meeting with a really good operator in Indianapolis. I had written some questions taken from Bigger Pockets and elsewhere, and made a list of them. And we had a half an hour meeting, and we were 15 minutes late to the meeting because of the traffic. And after we had a meeting for 15 minutes with them, I handed him a check.
Interesting.
He had a deal right there, and deal was in Dayton, Ohio. I handed him a check. And after that, I started learning and started networking with other people. And in the very first year, I first couple of years, I invested about $500,000 as passive investments.
Interesting. So I'm going to pivot now a little bit and talk about the very first investment that you did as a general partner, the very first apartment building, right? Because it's one thing to invest as a limited partner. The fear level is still there, but you have someone guiding you through because they already have the systems in place. They're finding the deal. They're helping to finance it, right? They have the systems in place, but you're a quick learner. So then you went out on your own and started looking for opportunities. So talk us through the very first investment that you made as a general partner, and what was the story behind that opportunity?
Okay, so as I was learning more and more about the multifamily, I was networking, I was going to events, and then I joined Rod Khleif's mastermind.
Gotcha.
And fortunately, that mastermind was in San Diego. I met a gentleman, his name was Jeff Greenberg, and I had followed him on Bigger Pockets for maybe a year or so. So he sat next to me and he introduced me, and he told me that he has a deal. I said, I want to be a GP. And I said, send me these, because I had learned so much. I knew how to talk, how to underwrite, and how to analyze these deals.
Right.
So I did all that, and he had a 225 unit in Amarillo, Texas. So he offered me a general partnership. Most of my research in the airplane, and invested $29 on the internet in the plane from San Diego coming back. So it was me and my son. My son had also went with me that time. So we discussed and everything, and we decided, I came here and decided to move on with the general partnership.
Interesting. KK, I really appreciate you sharing that. We're in a very unique market right now. We're in a market that's being challenged with COVID-19. So the investment landscape has changed and is continuing to change. What challenges are you seeing right now in this space, especially as you're looking for opportunity, right? What are some of the challenges that you're seeing right now that you can share with our audience?
I sit on 3 asset management calls every week. We spend a half an hour talking to the management, and also between us, the general partners. The first maybe half an hour, 45 minutes with the property management, and then between us. We all take notes. I write the minutes on the properties, and we are doing pretty good, actually. The collections are higher, and I even looked at the national data this morning, and the collections are higher, and the occupancy is still higher. And we haven't seen much difference, especially in the B-class assets. There is some in the C, but there are some tenants in every property that is 2 and 3 out of 200, 2 or 3 that they're taking the benefit of COVID because they can't be evicted. They're not paying rents.
Sure.
But otherwise, occupancy and everything is pretty good as of today.
The market is shifting. I know that right now, we have a lot of stimulus out there in the economy, helping to prop up. In some cases, maybe helping to stabilize. Well, not in some cases, helping to stabilize the markets, right? But, there's a lot of talk of the stimulus changing because, some of the stimulus is going to come to an end, especially with benefits to residents, as an example. How do you feel that's going to impact, apartment communities and, rents or collections?
First of all, for the last few years, everybody has been talking about the recession coming.
Right.
So the smart operators already built the recession into their underwritings even before this COVID happened. So I think I was also of the opinion that it might hurt the economy as well as it might hurt this business. So even if you compare it with the previous recession of 2008, there were only 0.04% of the apartment went to foreclosure as compared to 4% single family houses.
Interesting.
So I think apartments are very resilient. So if there are some resilient to recessions or situation like this, COVID, this has happened for the first time. The reason is because if you are losing some of your tenants of non-payment job loss, then you're getting some other tenants who are losing their houses
Sure.
because people still need a place to live.
Sure.
So you're getting some of those as compared to you're losing some to the recession or job loss. Then you're getting some of them from the foreclosures also.
Interesting. I think that's a really good point. You said something that really caught my ear, and that was the best operators, they were pricing the recession in, right?
They
Because
were
there's been a lot of
already,
conversation around that. So what are some of the things, KK, that you and your team are doing or have done in your underwriting to factor in, potential recession? Now we're in one. What are some of the things that you're doing right now when you underwrite to factor that in?
Okay, I'll tell you about the deal that we are raising money on right now.
Sure.
It's in the Galleria area of Houston, and so what we did, we bought this property before the COVID even hit. So we bought it at 22 million. It's 150 unit, and when COVID came and everything closed down, and we backed out a little bit, and after as things started opening and everything, and then we started renegotiating the price on it. So we renegotiated to 19.6 million instead of, so it was an 11% discount.
Interesting.
And also we underwrote it again, keeping COVID or recession in view. So we dropped our occupancy from 92%, though the property has historically performing at 97%. So we underwrote it at 84%. And also we did not have any rent increase in the very first year in the underwriting. We might, and I'm seeing we have a property in Atlanta, Georgia. We are still increasing the rents to the market rent.
Interesting.
But we underwrote that we are not going to increase any rent in the very first year, so that everything settled down. So that's when we start increasing the rents.
Sure.
We'd still be able to raise the rent on that property in the very first year. Maybe not as much, but maybe still able to raise. A lot of people living there are more than 2 years, so that maybe they don't move out just to pay the extra rent.
Right. I think that's a good point. And so if I'm hearing you correctly, I think the idea really is to understand the market and make your adjustments in underwriting to anticipate some of the risks.
Correct.
Not only associated with the market, but associate the economic risk as well, right? Which we're kind of going through, right
definitely.
now. And so what advice would you give, a seasoned operator, not a limited partner, not someone new coming into the business, but what advice would you give a seasoned operator, right, looking for opportunity in this market currently?
I think there are opportunities every time. There are opportunities now. There were opportunities before, and there are going to be opportunities in future. All you have to do is underwrite your deal properly, not aggressively. I have seen people underwriting at 95%, and day one they're going in and raising the rents. That might be a little challenge.
Sure.
In this kind of situation.
Sure.
So if you build that, your vacancy a little bit higher than normal, and also do the sensitivity analysis and make sure you have a less than 70 break-even point, then you'll get through it. And it's always a long term. And first year is always hard on every property.
Right.
After that, once it gets stabilized, so it should be good, because in 5 years, the things are going to be a lot better than what they are now.
Right. And so you use the 70% break-even ratio. Is that what you're underwriting to? So you're essentially saying,
yes,
at 70% occupancy, we need to be able to break even.
Pay our bills. Yep. Yeah. Actually, 69%. On this property is 69%.
It's 69%.
Yeah, even at occupancy at 69%, we'll be able to break even.
Is that your target ratio, or is that just the outcome of the underwriting based on this particular asset?
I think this is something that every underwriter should be keeping in mind, that some things could happen. Nobody predicted COVID.
Sure.
Nobody predicts hurricanes or whatever natural calamities. So if something happens and there is a dip, you should be able to bear that dip.
Right. Right.
You should have enough cushion in there so that if there is a dip on that property, and in our previous property in Amarillo, Texas, and that was a repositioned property, and we had like a 3-year stabilization plan, but we moved all that into first year, and our occupancy went down to 66%, but we were still able to pay our bills.
Interesting. Amarillo, Texas, that's in the Panhandle.
Yes.
Why Amarillo? Because that's an ag market. It's kind of a unique market. There are some Fortune 1000 companies out in that area, but why Amarillo out of, some of the other?
That was our first deal, as I told you, with Jeff Greenberg, and they could answer this better. And I got on the later time.
Sure.
So, but Amarillo is a great market for apartments.
Yeah.
Actually, all of Texas is a great market.
Do you have any favorites, KK, in terms of states and submarkets? Do you have your personal favorites?
I think it's not just the favorite market. It has to be the favorite operators as well.
Okay. Well, can you talk a little bit about that?
Yeah, a good operator can make a bad deal. And I always say this on podcasts. A good operator can make a bad deal into a good deal.
Right.
A bad operator can make a good deal into a bad deal.
Sure.
So it doesn't matter what market is it in. So if the operator is not paying attention, not operating the property very well, and it goes to the gas station business, laundromat business as well. And the very first gas station that we bought was doing 32,000 of inside sales, and now it's doing about 75,000.
Interesting.
And that has been a gold mine for us. We have had that for 20 years. All other gas stations also, we have done the same thing. Another good example is we have a gas station here in Garrett, Indiana. At one point, I always wanted to buy that gas station, and somebody, sorry for diverting, but that's a good example.
Please do.
Yeah. So I offered, the broker approached me if I wanted to buy that gas station. I always wanted to buy that gas station, but somebody offered $200,000 more than I did from New York, and he bought that gas station with other people's money. And he made his son the manager here, and he knew nothing about the gas station business.
Oh, boy.
He was born and raised here. He didn't want to work like us. So he was spending like 5-6 hours a day, just the weekdays, and his cashiers won't open. So he took that gas station down the hill, and some of his cashiers were not opening in the morning, but he would go and open. If my cashier wouldn't open, my partner wouldn't open, I would go ahead and open the store at 6 a.m. But he was not opening. Sometimes the store was closed until 9. And after a year, he sold for a loss of, I think, about $500,000.
And did you buy it from him at that point?
Correct. We bought it. We bought it when it was all the way down, and we bought that gas station. We turned it around. We have had that gas station for about 10 years now.
Interesting. And is it one of your best performers?
It's one of the best.
Yeah. It's really interesting, right? I mean, it's one thing to be really good at acquiring a property, right? You can also add great financing to it to improve the margins associated with that property and reduce risk. But it's something entirely different, right, to be able to operate that asset extraordinarily well.
Correct.
And so what would be, I know we're approaching the end of the show, but can you please share a couple of points on things to consider to be able to operate an asset and convert that into a high performing asset, right? So taking something that's average, an apartment building, and really converting it into a thriving community. That's what the show is all about.
First of all, I want to say, if the asset manager is not having weekly calls, that property cannot perform well. If you are not on top of the management company, if you just leave that, and I have seen some operators, they're buying properties here and there every 3 months and leaving it to the property manager to manage the property, and then they're going and buying some other properties. I don't recommend that. From day one, you should have, and that is accountability as well.
Sure.
So if you have like 7 people, you can't miss that call. And then you're speaking for an hour in front of your partners, and you sometimes people and investors also, they let the investors join that call also. So they know what they're going on, and then you are more accountable to make sure that it is performing very well.
Right, right.
So that is one thing. And also underwritings. And I have seen a lot of people are not underwriting conservatively. They're aggressively underwriting the deals just to make the deal work for them, not for the investors.
Sure.
So they're not up to the point. They are not performing on the pro forma because they underwrote it very aggressively. And the rent bumps, people a lot of times when they do rent comps, they just go to Rentometer and do the rent comps. You can start there. It's not bad. There are other websites as well. But I think going physically to the properties and comparing apples to apple to make sure that you are projecting the right bumps and that market can support those kind of bumps.
Sure, sure. So the research around, just what rents are in that market, and of course, how those rents, if those rents actually can be proved out, right? So I know that's a really great comment. What resources do you use for that, KK? I know you talked about Rentometer. There's CoStar, there's Reese, apartment data,
Neighborhood Scout, so many there are, but those are all the starting points. You can
Sure.
just rely on everything. Most of these websites, they use census.gov as their source of data. But I think those are, for example, CoStar. Everybody uses CoStar.
Right.
But CoStar has like 6 months behind on the data. So you might look at the CoStar and say, hey, your competition is at $800 on 2-bedroom. And then you have to see, is it the same size? Does it have the same amenities? So does it have a washer and dryer? So it could be, they could have a fireplace, they could have a washer and dryer in the property, and you're not comparing apple to apple because your property is not offering washer dryer.
Sure.
They're offering it, and I have seen properties offering a lot of these free goodies to keep their rents up, and even the utilities. So you have to compare those utilities as well, whether they are paid by the tenant or they're paid by the owner, and what are the utilities paid by the tenant. So you should be comparing apple to apples, adding those things to the comparison. Don't just trust on the online websites for comparison. Those
Sure.
are good. Those are good starting points, though. You don't have to go to fly to the property to do your research in the beginning, but eventually you do.
Right, right. So we're approaching the end of the show now. KK, I wanted to ask you, one last question because you brought this up and I thought it was a really good point about asset management. What software systems are you using to create a better experience for your investors?
On these here, we are not using any software we have IMS for the investor relations, where they can go check their financials, etc., documents and their returns. That's not for the asset management, that's for the investor relation part.
Sure.
But we have looked at a few, but necessarily you don't have to use a software to do the asset management or the construction management. Even Excel works pretty good. Not every property is the same. Not every value add strategy is the same. So I don't think there are even very good asset management softwares out there. So I have the asset management calls that I sit on are not using any software. We are using Google Drive and sharing documents there and everything.
Now, in terms of, you mentioned IMS, is that for investor relations, is that a product, or are you just talking about you've built out your own information systems to share data with your investors?
No, that's a product that you can integrate to your website, it's a portal where investors can log and commit investments and see your deals and download documents and K1s. You can upload K1s and they can download their K1s.
Sure.
And they can look at the financials, reports and everything whenever they want. So you don't have to send emails. So you just every quarter you upload the financials to their portals.
Well, KK, I really appreciate you being a guest on this show. Really love the insights. I'm going to summarize a little bit some of the things that we talked about, right? Inside of this business, we have massive, massive opportunity. But, a lot of it is not just based on going to school, getting educated, but it really comes down to combining our education and our experiences with taking massive action, right? Correct. One of the things I tell my kids is you don't want to be the smartest dummy in the room. you want to be the person that understands how to use information and apply it. So I give them a really simple formula. I go, look, when it's all said and done, I just want you to remember one simple formula, and that is your mindset plus your skill set, okay, plus action equals success. Okay, I said if you take one of those elements out of the equation, it's very difficult to achieve success. You have to have all three. And you touched on that very, very well. And so I'm really grateful for how you walked us through that whole cycle. And then you concluded with talking about the importance of weekly calls to be able to manage performance and manage assets extraordinarily well, right? Or manage up assets, as we say in our business. So I want to just personally thank you for being on the show. You've been a tremendous guest.
Thank you.
Now, is there anything you'd like to ask of me, KK, that you feel might add some value, to our audience? Okay,
I want to add a couple of things.
Please.
First is 80% of everything is just your mindset. So whether it's a gas station, laundromat, or multifamily, single family, 80% is your mindset that you're ready to take action.
Right.
And I always say this on my podcast whenever I am invited to all your audience: invest in yourself before you invest in any real estate.
I love that. So what would be an example of that, just to give our audience some context?
To learn, network and learn before you take any action. Not that you keep learning, don't take action. I have seen people, they have never taken action, but they have more knowledge than I do, but right. they are always afraid and have never taken action. So it's all about your mindset, whether you're ready to take action. But before you take your action, make sure you invest in yourself and learn. So you're very careful while making decisions.
Yeah. No, I think that's great advice. That's tremendous advice. So I want to thank you for that. Is there anything that you want to ask of me that you feel might add some value to our audience?
Well, I think we are very close to the timing. So I just wanted to let your audience know that if they want to reach out to me, and they can reach out through our website, growrichcapital.com, or they can send me an email, schedule a call with me on our website as well, or send me an email at info@growrichcapital.com and have a chat with me. And
yeah, no problem. I appreciate you mentioning that. I'm very welcoming of that. So if you have opportunities that you feel make sense for specific accredited investors, by all means. I think this business is very unique. There's so much opportunity out there that I often believe that people are going to gravitate towards the opportunities that they feel make sense for them, especially if they're very experienced. So I appreciate you mentioning that. Well, KK, thank you so much for being on the show and for sharing your experiences. Grateful to have you, and I look forward to our next conversation.
Thank you very much for having me on your show, John.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.